Welcome to The Explainer. Today, we're looking at one of those fascinating days on Wall Street where the market just couldn't seem to make up its mind. We're going to dig into the powerful forces that were trying to push it higher and all the serious worries that were pulling it right back down.
So let me tell you about the stock market on September 12th. It was a day that sent some seriously mixed signals, and it really tells a story about the exact moment we're in right now.
All right, so here's the final scorecard for the day. You can see the Dow and the S&P 500, they both dipped a little bit into the red. But the real headline here? The NASDAQ. It completely bucked the trend and actually finished higher, all thanks to the continued strength in tech. And that split right there? That's what we're talking about.
This really brings us to the big question, doesn't it? We've got a classic tug of war. On one side of the rope, you have this huge sense of optimism about what's coming next. But on the other, you have some very real, persistent worries. So let's break down who's pulling on each end, starting with the optimists.
So what's got people so excited? Well, it's being fueled by two massive themes. First, this growing hope that the Federal Reserve is finally going to start cutting interest rates. And second, the seemingly unstoppable momentum of, you guessed it, artificial intelligence.
Just how big is this hope for rate cuts? It kind of boils down to this one single number, 4. So what does it mean? Well, this is Morgan Stanley's bold prediction. They're saying that a slowing job market will pretty much force the Fed to cut interest rates 4 times by January. Now, that's the kind of talk that can really get a market moving.
And you know, that kind of optimism is infectious. You've got major firms raising their expectations for the year. This quote from Yardeni Research just captures the mood perfectly. They're not only bumping up their year-end target for the S&P 500, they're saying there's a 1 in 4 chance the market could melt up, which is basically a rapid, supercharged rally.
And the other engine driving all this optimism? AI. It was just firing on all cylinders. You had Microsoft locking in its crucial partnership with OpenAI, which investors loved. At the same time, the chipmaker Micron hit a record high after saying it's hiking prices. And Supermicro, they surged after shipping out their powerful new AI servers. See, this wasn't just about one company. It was the entire AI ecosystem flexing its muscle.
Okay, now let's look at the other side of that rope. Pulling just as hard in the opposite direction were the bears, all the investors who are focused on caution, on stubborn inflation, and some very real economic risks.
And this chart just brilliantly illustrates the tough spot the Federal Reserve is in. I mean, look at this. On one side, you have a slowing job market and people feeling less confident. Those are huge reasons to cut interest rates to give the economy a boost. But on the other side, inflation is just proving to be sticky, and folks are getting more worried about prices in the long run. If the Fed cuts too soon, inflation could flare up, but if they wait too long, the economy could stall out. Not an easy decision.
And speaking of that weak consumer confidence, this was the big economic number that dropped. The University of Michigan survey showed that how people feel about the economy took an unexpected nosedive in September. And that matters because when consumers get nervous, they usually spend less, and that can be a major warning sign.
And this brings us to a really crucial point. Some experts are starting to think that maybe, just maybe, investors are getting a little ahead of themselves. Richard Bernstein Research sums it up perfectly here. They're arguing the market is acting like we're headed for a Goldilocks scenario. You know, not too hot, not too cold, just right. But they're warning that the chances of the Fed actually pulling that off are pretty low. Of course, the U.S. market doesn't exist in a bubble. There are also a bunch of global events happening that were adding to the uncertainty and giving those cautious investors plenty more to worry about.
And yet, the global pressure map was incredibly busy. You had brewing trade tensions from China to Mexico, the escalating conflict in Ukraine pushing oil prices higher, and even the threat of a U.S. government shutdown looming right around the corner. Every single one of these headlines just added another layer of risk to an already jittery market.
So, after all that pulling back and forth, what should we actually be watching for? What's the real takeaway from a complicated day like this? Well, it really all boils down to 2 critical questions that are hanging over the entire market.
And here they are. Risk number 1 is all about the Fed. The market is already priced in those big rate cuts we talked about. So what happens if the Fed doesn't deliver? That disappointment could trigger a really sharp sell-off. And risk number 2 is global tensions. All those headlines we just saw could easily get worse, which could damage the economy and scare investors. These are the 2 big uncertainties everyone's watching.
And so, we end right where we began, with a market caught in a massive tug of war. The AI boom and all those hopes for rate cuts are pulling hard one way, while inflation fears and global risks are pulling just as hard the other. The big question now is,
Which side is going to win?